Hey, it's Jim, and this is level 3 of the CFA program, the Private Markets Pathway, and the learning module on private special situations. You might recall a couple of learning modules ago, there was one paragraph about these private special situations, and in that learning module, it really talked primarily about firms that are in distress. And that, of course, is going to be the focus in this particular learning module. But there are some other scenarios that we're going to have to consider. We'll talk about mergers. One of the cool terms that shows up in the beginning of this learning module is financial dislocation. I never really heard that term before, but sure sounds like there are opportunities for investment in firms that are failing, about to fail, but have the potential to recover. And remember, they don't have to recover all the way. You can arrange investments in these distressed and dislocated securities and still buy low and sell high without them emerging from financial distress. Just a handful of learning outcome statements here. We'll talk about the characteristics. And there we go. Distressed debt. That's a big deal. That's a big point of emphasis here in this learning module. And then we'll have to perform some due diligence, which we seem to do in almost every one of these private investments learning modules. And then we'll talk about risk and return towards the end of the slide deck. So look at this definition that the Institute gives us: stressed, distressed, or event-driven opportunity. So we'll talk about those in a couple of slides. There's that term financial dislocation, when market prices deviate from their expected levels. And so I had to scratch my head when I try to think about the actual definition of financial dislocation. How often do prices deviate from their expected levels? Maybe lots of times. But in particular, we need to worry about these 4 areas down here. So this is a really good exam question. Economic crisis. I mean, think COVID. Think the 2008 financial crisis. Shifts in liquidity. Of course, we had liquidity issues during both of those time periods. But there can be shifts in liquidity during normal economic time periods because of supply and demand conditions for a particular company's debt securities, or maybe even its equity securities. Market constraints. Think about it this way: that the number of firms trading on U.S. stock exchanges used to be this big, and now it's only this big. So we're seeing trading going on in a fewer number of securities. I'm not sure if that's a constraint just yet, but clearly there are constraints out there that are market related. And then we talk at length about this throughout the CFA program, levels 1, 2, and 3, that we need to perform our analysis at the micro level and then at the macro level, and that macro level includes industry analysis, macroeconomic analysis, and then specific factors related to the company. That would be a microeconomic analysis. So here we go. Financial distress. Yeah, look down at the bottom. Partial payment, delayed payment. Yeah, so failure to timely pay, contractual debt obligations. Sometimes borrowers will just pick up the phone and call the lender and say, "Hey, I owe you $100 next week. Will you take $90? Will you take $84? Will you take $8?" So we have to worry about not only the magnitude of the payment, but also the timeliness of the payment. Financial distress also occurs, and this is a really good question, if there are violations in the debt covenant. So remember, there are positive covenants and there are negative covenants. So there might be something in there that sounds like, hey, let's take a look at the cash flows. If the cash flows in relation to the interest payments on the debt are some ratio or some multiple, whatever it might be, depending on what you put in the numerator and what you put in the denominator. If it falls above or below that, well, then that's in violation. So that's financial distress as well. And then, of course, we can just look at the market value. Now, this is actual market value. We use models, going back to level 1 when we did that very simple, I call it the kindergarten bond pricing model, where we just use our 5-time value of money buttons. So make sure you're aware of market values and then theoretic values below its obligations. So there's a little graph, or not a graph, a little illustration down at the bottom that for partial payment. Now, what are these causes of financial distress, economic downturns? So this is everything that we studied inside of macroeconomics. Could be things like unemployment, could be things like contraction of GDP, could be recessions, could be almost anything that we know about. Company or industry factors. So company, that's a micro. Industry factors, that's kind of a combination of micro and macro, but it's mostly macro. When I advise my students in projects that they have for their other business classes, I always tell them to do a SWOT analysis, and so that's kind of what's going on here inside of the purple. Strengths, weaknesses. Okay, so weaknesses, value chain, competition, competitive positions, weakening market risk, excessive operating leverage. So strengths, weaknesses, opportunities, and threats. But these things here can be combined to consider to be company or industry factors that would lead to financial distress. So how can we, as good old private investors, take advantage of this? We can buy some bonds or loans. We can buy shares of stock. We can buy hybrid securities. We can actually go in and purchase those assets during liquidation, and we can provide financing to firms in distress. So we've got these risks associated with this financial dislocation. What are these unique risks? So here, watch this here. So we got a 1 and a 2 and a 3 and a 4, and then somewhere down here there's a 5. So these are really, really good exam questions where the institute would give you a scenario under which they would say, hey, which of the following unique risks to distressed securities applies in this case? So this credit value adjustment, this is really a cool thing. Potential loss due to counterparty default risk. So think about default risk, credit risk, that's kind of the big umbrella term, and counterparty or third-party risk. Here's the example that I'll share with you guys now. Let's suppose that you and I agree to trade a forward contract on gold, and I agree to buy gold from you in 1 month's time. Let's just say it's a forward contract for $2,000 an ounce. And the current market price of gold is $3,000 an ounce. So I'm super happy, right? I have the right and I have the obligation to buy at $2,000. You're not happy because the price is $3,000. So that must mean that if we mark this to market, I'm up $1,000, right? So what's the value of my position? Well, what did I say? That was a month in advance. So take the present value of that, whatever that present value is. Now, let's just suppose over that next month that the price of gold stays somewhere around $3,000. So you're going to owe me $1,000. But not only do you have to have the ability to pay me that $1,000, you have to have the willingness to pay me. I mean, I could show up at your door in a month's time and you could say, you know what, Jim, I don't like you at all. I'm not paying you that $1,000, even though I have tons and tons of money over here. So ability and willingness to pay that risk. So is my position really, is my value, is the market value of my position really the present value of that 1,000, or is it the present value of that 1,000 minus something else? And that's what this credit value adjustment is. So I want you to think about it in the following terms. Now I'm going to show you how to compute this in the next slide, but for now, I want you to think about this. So here I am. You owe me $1,000 in a month. Let's just suppose the present value is $950, right? So the value of my position is $950. But I'm worried about your ability and your willingness to pay me. So what I do is I go to a bank and I say, hey, if this person over here doesn't pay me my $950 or $1,000, whatever it is in a month's time, will you pay me that? All right, so the bank, they always say yes, right? Investment bankers, they're always willing to write contracts. So what am I doing? I'm hedging with the bank. Maybe it's a credit default swap, maybe it's another forward contract, maybe, some kind of derivative over there. So the question then becomes, how much is the bank going to charge me, charge me to hedge that risk. Well, that's really the kind of conceptual idea of that credit value adjustment. So if the bank takes a look at you, right, the bank, you're the third party risk. If the bank looks at you and say, you know what, Jim, for the next month, I'm going to charge you $50. So now what's my position? You're going to owe me $1,000 in a month's time, let's say. Present value is $950, plus I have to pay the bank $50, so that means that my position is $900. Does that make sense? Hopefully that makes sense. So the credit value adjustment is the cost of hedging that I have to pay the bank over there. Now, let's go ahead and compute this with some other factors here. Now note, the LOS doesn't say compute the credit value adjustment, just discuss and explain, kinds of the risk. So we're in this context of explaining third-party risk, and then how do we make adjustments in the position to reflect that third-party risk? All right, so some terms going down the left-hand column there. Expected exposure, that's the total projected exposure in the event of default. That's my $1,000, okay? Now, what we didn't talk about is some kind of recovery rate, and this has everything to do with collateral. Now, if you put up $0 in collateral, well, then the recovery rate is 0%. But suppose you put up a treasury security that's worth $500. Well, what do I know? I know that if you default, then I have this treasury that's worth $500. So the recovery rate is based on the value of the collateral. Then what we can do is compute this loss given default, which is the exposure, that expected exposure at the top, $1,000, what did I say, and multiply that by 1 minus the recovery rate, 40%, 50%, 60%, whatever that is. So that's the loss given default, which is really just reflective of collateral. Introduce this concept of the probability of default. This, of course, is a number between 0 and 1, which is reflective of the financial condition of the party who is that owes me. This is you, right? This is the party that owes me money. What we can do then is we can multiply the probability of default times the loss given default, and that gives us something called the expected loss. Then what we can do is we can compute the present value of that expected loss. We'll probably discount it at the risk-free rate of interest, although there might be some scenarios under which we don't. But we'll probably do it at the risk-free rate of interest, and that's my advice on the exam. Even though you don't have to calculate, there might be some kind of an explanation question in there. So you take the present value, and that is the credit value adjustment. So that would have been, what did I say in my earlier example? The bank was going to charge me $50 to hedge that position. So there's the $50. That's the present value. Now, if you and I have a gold future, forward contract and an oil forward contract and a share of Procter & Gamble forward contract and a diamond forward contract and whatever, did I list 5 of them? If we had 5 of them there, this credit value adjustment would be just the sum of the present value of those expected losses. Now here's some definitional stuff that I always struggle with. I teach my students to think of solvency in terms of short term, and think of bankruptcy in the idea of long term. But the Institute seems to switch those terms interchangeably. So long-term solvency, short-term liquidity. So think about it and distinguish between those two. But think about it this way. In the short term, liquidity issue is the inability to meet short-term obligations. Whatever those short-term obligations might be, it might be a week's time. Long-term solvency issues, which I tend to think of as leading towards bankruptcy or financial distress, is when the cash flows, the operating cash flows of the firm are not sufficient to cover the interest payments and whatever sinking fund payment is out there, and maybe some principal payments. So what does that mean there? So we have investor liquidity risk. A lot of these companies facing financial distress have limited ability to borrow capital and limited liquidity because lots and lots of investors out there are selling. They're selling their bonds. They're selling their shares of stock. So this is a big risk. This is potentially a big risk for firms, and one in which that you and I, as private investors, might be able to take advantage of. Operational risk, let me just remind you what that is. That's a good definition. I always think of it as variability in cash flows due to inadequate or failed, you remember this, like internal processes, people, systems, and then you have to throw external events like an earthquake or COVID out there. So those are all operational risks. Legal risks, you know what those things are. You guys probably have watched that really good movie called The Big Short. It was a great book. I mean, I've seen the movie. It was a good movie. It was a great book. Fascinating kind of stuff. But the dude who wrote that also wrote a book called Boomerang. This didn't quite get the attention that The Big Short did. But it's really a fascinating story about sovereign borrowers. And this dude writes about Ireland and Iceland and Greece. You probably know these stories, in 2008 and 2012. These countries were under severe financial pressure. And so the question then becomes here, as good private investors, how can we identify sovereign borrowers that are susceptible to financial distress and have the ability to recover? And of course, the ability to recover depends on lots and lots of things, but it depends on, are there other banks out there? Are there other governments out there that are going to bail them out? Of course, you guys that watched The Big Short at the very end of the movie, that was the whole stressful thing. Oh my gosh, the banks are going to bail them out. The banks are going to bail them out. So here are some interesting factors here that we would look for to identify sovereign borrowers that are susceptible to financial distress. So limited economic diversification. Iceland is a great example. You read this book Boomerang, and it's really funny. I mean, the Icelanders, they've been experts on fishing for millions of years, and then within a period of about 2 years, everybody threw their boats away and their fishing rods away, and everybody went into investment banking. So limited economic diversification, less developed financial markets. This was true for Iceland and Ireland, and maybe not Greece so much. Fewer foreign trade partners. I'm not sure that was too relevant for those three countries. Fixed exchange regimes. Okay, so they're important things. So if we're the bondholder, we're going to incur losses. This is what I was saying earlier, right? We're not going to get our interest and principal payments in a timely manner. So there are grace periods when there's restructuring, extended time payments, and other borrower considerations. And then reputational risk, you guys probably know what this means. That look, if we're identified as incompetent, then the word gets out, especially now that you can just take a picture of yourself and you post it somewhere. I don't know anything about social media. You post it somewhere and it's all over the place, just like that. I always think about, some silly scenarios under which, while I'm making one of these videos, I could, take a selfie from behind and you could see everything that's in my little office here. And you might say, oh, look at Jim. Look at what he's doing in his spare time. Well, I'd love to share all this with you. I promise you it's all fun stuff. Now, remember, we're going to shift a little bit here away from financial distress into these other kinds of special investment situations. So we've got mergers, acquisitions, and divestitures, regulatory sanctions, and issues that affect industry or the supply chain. The focus here is going to be on mergers, and I always struggle when the Institute seems to use the word arbitrage out there for lots and lots of different things that may or may not be the exact technical and academic definition of arbitrage. And I've said this to you before. I always think of arbitrage as, no investment, no risk, but a positive return, right? There's no risk. Now, these things here, we're calling these merger arbitrage opportunities, and they're special scenarios, they're special situations under which we can minimize risk and still earn some positive return, but I'm not sure we can eliminate risk. So that's just my personal thought there. Take that and just throw it out with your weekly garbage as you're preparing for the exam. So what do we know about mergers and acquisitions? We know, I don't know if you know this, but I know this going back to my days in graduate school. But I know I told you this back in level 1 when we talked about mergers and acquisitions. The average takeover premium is about 50%. So if a stock is trading for $100, the average takeover price would be $150. So what's the strategy? Well, look over here. Just buy shares in the target company, because what happens? The stock prices for target companies are going to rise by 30%, 40%, 50%. I mean, that sounds like enough to meet any private investment target or minimum internal rate of return. Now, this is in a cash for stock transaction. So you buy up the target shares and then you get cash from the acquiring firm. What did I say? $150, $145. Now, a couple of interesting things here. I don't really think about this in terms of pure arbitrage because there are lots and lots of things that can happen. Just read the Wall Street Journal every day, and I hope you're reading the Wall Street Journal every day. My children tell me don't point, but I'm pointing at you. If you read the Wall Street Journal, you'll know that when you have two companies who want to merge, that there's another person out there that likes to get involved, and that person is the federal government. The federal government likes to come in and say, you know what, we don't really like this because whatever reason the federal government gives. So lots of times these mergers and acquisitions, they don't ever materialize. So if you buy shares in the target, you're not guaranteed. It's not a risk-free, but it's a great strategy. I mean, I promise you that if you invest in targets, 10 targets, probably 8 or 9 of them are going to materialize. Now the question then becomes, what do you do? And this is a little bit closer to what I would think as a definition of arbitrage, a stock for stock merger or acquisition. So you do the same thing. You buy the target shares because you're going to get a 50% premium, but then what you do is you either short that acquirer shares or you sell those acquirer shares, because the net present value of lots of these mergers and acquisitions is negative because of that 50% premium. That's why it takes 5 years, 10 years to kind of figure out whether or not a merger or an acquisition has been successful, because you have to overcome that tremendous initial cost. I mean, imagine if you go shopping, and I know we've had lots of inflation here in the United States over the last several years, but suppose that you went to buy a loaf of bread and it was $2 a year ago, and now it's $3. There's a 50%. I mean, that starts weighing in on your pocketbook. Sooner or later, you're going to start making your own bread. Now, here's where the Institute kind of gets away with saying the arbitrage. So what we're going to do is we're going to look at this spread, which is the difference between the announced acquisition price and the post-announcement market price. And that could be some time period under which all sorts of crazy things could happen. Like imagine that you have a merger today, and so you do this stuff, whether it's, let me go back here, whether it's cash for stock or stock for stock. So you buy the target shares today, and next week we have COVID part 2. Everybody's stock price falls, the merger gets canceled. That's why the Institute is so clever when they put these learning modules together. That's why there was an emphasis, and I feel like I emphasized enough in a previous slide about this operational risk and the need to monitor the external events. Okay, enough said for that. Yeah, I was just saying about why do these mergers and acquisitions fail? So unavailable debt financing, that makes sense. Well, there we go. Government, yep. Changes in industry or economic conditions, I just mentioned that. Due diligence uncovers material misrepresentation. This is exactly what happened in Greece. Apparently in Greece, what is this, 12 or 14 years ago, some officials in Greece, they just said, you know what, we have all these bonds over here. We're not going to tell anybody about those bonds that are outstanding. This was clearly material misrepresentation. And then one of the things I learned early on in graduate school was this idea of the free rider problem and the winner's curse. If you have multiple bidders competing for a target firm, what happens? They bid up the firm, and all of a sudden you used to be at 50%, now we're at 75% or 80%. And so you have these counteroffers, and then the winner's curse is the firm that wins the bidding war loses because they had to pay 75 or 80% or 100% over top of the current market price. So these are really good. These are good exam questions. Let's go ahead and finish up one more slide with this particular LOS. How about some additional merger arbitrage opportunities? A lot of times when a firm goes through this change of control, there might be a change of control clause in there in which the issuer might be required to repurchase the outstanding bonds. So this is kind of like a call provision in there, that it's not really a callable bond, but it's a callable bond when there's a merger or an acquisition. And so this price could be done at a premium or at a discount. There might be a bond tender offer. We talk about stock tender offers all the time, but there could be a tender offer for the bonds. Capital structure changes. There might be mispricing. If there's substantial changes in the debt equity ratio, then it's possible to take long or short positions in the bonds or the shares of stock. And you can combine that probably with a regular old interest rate swap, depending on whether it's a fixed for floating. You could use an interest rate swap or a credit default swap. So depending on whether or not you want to manage interest rate risk or default risk. And then convertible arbitrage. I think we talked about this back in level 2. What we're trying to do here is look at the convertible bond. Maybe that thing is mispriced. Maybe it's undervalued because this firm is in financial distress. Who wants to buy the bonds? So maybe those convertible bonds are worth it, especially with that potential for capital gain on the equity side of that derivative security. I'm guessing I don't need to read this slide to you here, right? Common causes of financial distress. Lots and lots of debt and capital structure, changes in the value of those assets, poor operating performance, right? There we go. That's all good stuff. You guys know that. Here we go. Liquidity in the short term, insolvency in the long term. So what do we do in the short term? Debt payment rescheduling, extensions, covenant changes. What do we do in the long term? Gosh, I tell my students this all the time. If you sell your assets without wanting to, if you're in financial dislocation, this is not a good thing. Debt for debt. You read the Wall Street Journal, you hear about this, you read about this all the time. First, issuing bonds to retire bonds over here. Debt for equity, equity for debt, all sorts of capital structure changes in the purple there over on the right. Bankruptcy. What are we doing? We're going to liquidate. We're going to do the DIP financing, the debtor in possession, prepackaged bankruptcy, meaning that, we know what it's going to look like and we're going to go ahead and do it. And then in the end, there are no surprises, right? And then free fall bankruptcy. So to avoid bankruptcy depends on a couple of variables: cash position, expected financial shortfall, capital structure, and then regulatory constraints. I say this to you guys regularly. The Institute doesn't want us to be lawyers or legal experts, but they want us to know just a little bit about it. So here's the process. I would really struggle to come up with a good question here, but it's probably important to know this kind of stuff as you read through a vignette on the exam. So what do we start with? We start with this bankruptcy petition, and then we've got to worry about some kind of asset transfer. So what are we going to do? We're going to propose some reorganization. So we're either going to reorganize or we're going to liquidate. Failure to make debt payments, debt restructuring, or bankruptcy filing. These are all possibilities for debt restructuring. So when a firm announces any of these things, 1, 2, 3, well, then what we can do is we can go ahead and engage in those credit default swaps. Now, of course, those credit default swaps, as the firm is nearing bankruptcy, they're going to require a higher premium. But what we're focused on here is what are those triggering events So we have one or two of these events, and then they're triggered, and then we have another trigger. And so remember, these credit default swaps, they're 3 years, 5 years, 7-year instruments. And so you can buy these things before financial dislocation, during financial dislocation, maybe even after financial dislocation. The important point here is that, look, if we're using credit default swaps here as kind of an investment to take advantage of failures in bankruptcy, then we need to make sure we know what those trigger events are. That's all that is. Go ahead and get your phones out. Take a picture of this slide. This was taken right out of the learning module. And I think a couple of key differences here. Look down at the bottom. As you read the learning module, there's an emphasis on time period. So remember, this non-controlling strategy is about 6 months, maybe just a little bit longer. So that's pretty short term. If we're active in this non-controlling strategy, that's a couple of years. Active in the controlling strategy, that's 2 years, 3 years, maybe 4 years. And so if you look at the approach, that row, I think we talked a little bit about a bunch of those things going through. So take a picture of this. There's probably, what is that, 12 boxes in there. There's probably 12 good exam questions in this slide. Now, what I love about the Institute, which is something that has evolved over the years, is its love for Black-Scholes and Merton. And so what we're going to do now is we're going to go ahead and just spend a few moments. And this is a reminder, should be a reminder from stuff that we talked about in our corporate finance learning module. So this is known as the Merton Model. So I want you to think about this, that on the right-hand side of the balance sheet, you have a bond, and let's just suppose it's 100. And then below it, you have equity, and let's just suppose that that's 100. And then over on the balance sheet, on the left-hand side, you have $200 worth of assets. So debt equity ratio is 1. We're going to use the Black-Scholes-Merton option pricing model, and it's just referred to as the Robert Merton model, to value the debt and the equity. So I want you to think about this. The shareholders have a claim on the income stream generated by the product lines that the assets produce. That should make perfect sense. We know that from level 1. But now in this context, I want you to think about it. The shareholders own a call option on the assets of the business. They have the right, but not the obligation, to pay the bondholders, to pay off the bondholders, get rid of the bondholders, and then take full possession of the assets. Because remember now, as a bondholder, in many cases, the bond issue is secured by the assets. So the bondholders have a claim on that assets. The shareholders have a secondary claim on the assets only if the bondholders are paid. So what happens then is if by the end of the year, let's suppose the bonds mature for $100 at the end of the year, if the market value of the assets over on the left-hand side of the balance sheet is, let's say, 105, then what the shareholders will do is they will exercise the option, pay off the bondholders at $100, take possession of the assets, which are worth $105. That's an in-the-money option. Now, of course, given those numbers from just a few moments ago, if it truly was 100 and 100 on the right-hand side of the balance sheet, we would want those assets to be worth 300 or 400 or 500. Let's suppose it's 500. So what do the shareholders do? They pay off the bondholders for 100, get rid of the bondholders. There's no leverage now in the company. Take possession of those assets that's worth 500. Oh my gosh. So this is the beauty of leverage, using someone else's money, using the bondholders' capital to magnify the returns to the shareholders. So look at the top right. Let's go through some of these boxes. So equity is considered a call option on the residual value of the firm's assets over its debt obligations. That orange box is the key to understanding this Merton model. Sometimes the value of the assets might be, let's suppose it's $10, right? So why would the shareholders pay the bondholders $100 to take possession of something that's only worth $10? Well, what do the shareholders do? They just say, you know what, Mr. and Mrs. Bondholder, you can have those assets. We don't want them. So they allow the option to expire. Of course, the shareholders get nothing out of that. I mean, this is not good news. Shareholders want that to be $500 or let's say $600. So all these boxes here are part of the explanation of this Merton model. Now, if you want a review of the Black-Scholes-Merton option pricing model, there's a beautiful section in here in which you compute D1 and D2 and you work your way through. You calculate the value of the equity, you back into the value of the firm, you take the present value of the par value, and you get the value of the debt. I ask this question of my students in corporate finance all the time. It's a really super fun question. But the LOS here doesn't ask us to do any of those calculations. So it's really, if you can remember that orange, you should be able to answer. You should be able to answer those questions on the exam. Now, the Institute is very big on saying, all right, this is a great model. I think it's a super fun model, especially in an academic setting. But the question then becomes, can we apply it? And the answer is absolutely, we can apply it. But there are some limitations to this. You might remember that in order to compute the call price, in this case the equity price, you need some measure of standard deviation. So in this case, with a call option, it's the standard deviation on the share of stock. In this case here, we're looking at the standard deviation of the assets. So the one way to do this is take the net present value of all the product lines out there and compute the standard deviation and then convert it to a percent somehow. That would be the standard deviation that you should use. So one of the inputs is not directly observable. In my example, I just said that the bond was maturing in 1 year. I don't know if I said this, but I could just say that it's a zero coupon bond. But you can throw bonds that are in there that have floating coupon rates, that have fixed coupon rates. One might mature in a month, one might mature in 27 months, one might mature in 29 years. So you've got staggered maturities, you have different levels of seniority, and so this just complexifies it. Almost, I'm not going to say beyond, but almost beyond the ability to calculate it. If we have sudden capital structure changes, debt equity ratios, it's really difficult to be reflective of those sudden changes inside of the model. Yeah, remember Black-Scholes-Merton assumed continuous compounding, and clearly there's not continuous trading of a firm's bonds that is in financial dislocation. In fact, those bonds may trade once a week, once a month, once a decade, once a century, so that's a big problem. And then remember, we did some default probabilities just earlier. We didn't dive too deep into it. And the credit spreads, however we define the credit spread, maybe it's just the regular old spread over the treasury, maybe it's the Z spread, maybe it's the option adjusted spread, whatever is in there, boy, this is really going to be difficult to implement. So here's my advice for the exam, especially if this is multiple choices there. I'm promising you that orange is super important. If you have to explain something about why this has some limitations, I would say, I love this model. I just love it. Jim told us to love this model. It's really a fascinating model, but it does have some limitations, and here you have those. Now, also inside of this concept of financial dislocation is the ability to buy a convertible bond, right? You can just go buy a convertible bond. However, suppose that a distressed company doesn't have a convertible bond. Well, you can create a synthetic convertible bond by doing the following here. So what you're going to do is find out what a regular old bond price is selling for. Let's suppose it sells for 60 out of a par value of 100. You take that 60 and go ahead and put it in the bank, and you're going to earn a risk-free rate of interest. That's the depositing there. Then you're going to sell credit default swap protection. So you're selling this, which means somebody out there is going to pay you, right? They're going to pay you that semi-annual or annual premium. So you're receiving interest on your deposit. You're receiving interest from the credit default swap protection. And then you're going to enter a received fixed swap. So you're sending out the floating rate. And so that floating rate is going to be, well, whatever it is, right? You're getting these protection premiums, and you're getting the risk-free rate, which goes up and down. So you're sending that floating payment out, and you're receiving the fixed. So that kind of makes those three, the red, the orange, and the purple, that kind of makes them look like a regular old bond. Then what we do is we layer it with a call option on the shares of stock, which allows us to take advantage of any kind of appreciation if it does occur in this distressed bond. So remember those four things there. In fact, take your phone out and take a picture of this so you know how to create a synthetic convertible bond. Now, a couple of other arbitrage opportunities. You can isolate equity, you can isolate volatility, you can isolate credit, you can isolate other kinds of exposures, and you can do this using credit default swaps, you can do this using short positions, and you can do a regular old interest rate swap, which I mentioned a little bit ago. So I think the key to answering these questions here is to just say to yourself, you know what, whatever scenario I'm in, I can use these derivative securities to take advantage of this financial distress. Now, how about due diligence? You know that I say this regularly. Due diligence is really just getting out your gloves and your shovel and your working boots and just digging. So the problem here, special situations, is that inside of this arena of financial distress and mergers, you can't take your time. And a lot of times, we don't have enough time to perform this analysis, so limited time. Yeah, screening criteria is a super critical step, but combine that with the lack of time available, you may not be able to screen efficiently like we've done in the past. Yeah, statistical credit models, this is the problem, right? We're looking at history. Maybe we're trying to look with some current events, with some current statistics, but we're just trying to see if history repeats itself. So that probability of default is going to change over time. And clearly we can't rely on Moody's. We might be able to rely on the credit default swap market, but if we've got liquidity problems and timeliness problems, those credit default swaps might not be as informative as we would like them to be. We probably need to put together a worst case liquidation and then, bankruptcy court filings. Gosh, I'm going to go ahead and say it right now. This is the last thing that I want to do is go visit the bankruptcy court and then read all of these pages. Gosh, I have enough to get through the Wall Street Journal every day. Yeah, there's some more legal issues up at the top. How about some financial metrics? We know these ratios, and there's a ton of other ratios that you can use. So I'm guessing now at this point in level 3 that you have all of these, not just these 5, but tons of financial metrics somewhere embedded in the back of your brain so that you could call upon it if you needed to do it. A couple of things here. Make sure that not only do you know how to calculate these ratios, but let's make sure that we do two things. I say this to you guys regularly. Trend, what's the trend? So let's look at the last 3 or 5 years and then compare. We want to compare to the competition, but what we might want to do, and you'll see this here in just a second, we might want to compare what's going on now versus firms that used to be in financial dislocation but are now healthy. What was their trend analysis? And that gives us a pretty good footing to make a better judgment on strategic asset allocation, let's say. Disadvantages in the long term and the short term. Yeah, long-term investors might not be able to use some non-public confidential information. Didn't we talk about that in a previous slide deck here? Limited to using public information in the short term. So how do we do these special situations? We can use income-based. We can use the method of the comparables. We can use the asset-based approach. I think we've done this multiple times in level 1 and in level 2. What if we use, let's just go back here. What if you use that income-based approach? These are going to be discounted cash flows. Well, clearly those free cash flows are going to be lower. They might even be negative. There has to be a higher weighted average cost of capital to be reflective of, what do we do, those extra 5 risks in a previous slide, plus other risks that are out there. And then if we liquidate, there are no future cash flows after that liquidation. So you could, you got to compute, in order to compute liquidation value, you got to compute, what's the expected selling price of all of your assets. Yeah, a couple of drawbacks here. If we do this relative approach, we're going to compare those ratios with those of the non-distressed industry peers. This is what I was saying just a moment ago. I think it's probably helpful if we compare those to non-distressed, but also compare it to those that were distressed but are now healthy. Asset-based approach, we need to make sure we're doing this as a going concern. And then the hierarchy of claims. Prior to liquidation, we've got priority of claims. And then after and during liquidation, we've got this other direction. So who gets paid first? You know this. Short term, who gets paid second? Senior, who gets paid third? Subordinated debt. And then somewhere down there, there might be a shortfall. I'm not sure how much value this slide adds, to your basic understanding, but it's a good kind of a review. This is what I was saying earlier. Some firms successfully come out of bankruptcy. Those financial metrics of healthy peers should be used. Credit analysis models that we've used in level 1, a little bit in level 2 as well. Let's work through an example here as we're ending. So let's do revenues of $250, profitability of $50 million. Acquired, taken private 4 years ago. 70% debt, 25% equity, 5% convertible preference shares. All right. Currently the total assets of $210. All right. So let's figure this out. Right. Under scenario 1, which is a liquidation scenario, total assets sold will be 70% of their current value. So let's go ahead and figure out senior untrenched debt and mezzanine debt. So who are the lenders over on the right? Syndicateds and then a private credit. So what's the size there? We've got 55 and 90 and 15. So that should make perfect sense. So what is this recovery? So total assets of 210, liquidation value, take 70% of that 210, gives you 145. So the total debt outstanding, that sums to 160. And then the debt recovery on liquidation is, 147 over 160. So that's just about 92%. So 55 to the senior, 90 to the untrenched, and then the remaining $2 million, the $2 million goes to the mezzanine debt. So 100% recovery, but then only, what is that? Just a little bit more than 10% recovery. Those convertible preferred shareholders, they get nothing, right? Because the unsecured subordinated debt, they didn't get 100%. If that third teardrop is 100%, then the convertible preferred shareholders claim would be something that's positive. So let's go ahead to scenario 2 and see what happens. So what are we doing here? We're doing 7 years after its acquisition, normalized profitability of 70. The EV profitability multiple 4%, risk-free rate is 4%. All right, so there's 70 times 4. There's the multiple. So the EV 280. Let's take the present value of those things using that 4%. In year 4, so that's 248, 25% probability of distressed liquidation in this example. So we do the 25% times the, let's just go back here, times the 147, and then 75% times the 248. That's just a weighted average, so we get 225. Now there are special situation funds out there that are appropriate for strategic asset allocation. Of course, institutional investors, once again, we talked about this before, they've got to figure out what's the manager's experience, what's the manager's expertise. The general partner, I can use that term again, higher risk. Let me repeat this. Are we still out on the borrowing portfolio on that capital market line? So everything that goes into that kind of due diligence applies here. So we need to evaluate these fund managers on credit risk and liquidity risk and legal risk. And that takes us through our learning outcome statements. So I want you to go to those 3 vignettes at the end of this learning module and work through those. You should be able to get through most of those. I really encourage you to not look at the answers first of all and just sketch out an answer and then go and learn from the answers and say, oh, I should have been thinking this way. I should have been thinking that way. So thanks for watching and good luck studying.